What is going on, guys? Welcome to Stock Talk with Nico Kritikos. Today, we are going to be doing some stock analysis for Estee Lauder stock, ticker EL. I know we are in a different filming location right now, but that is okay. We're still going to make it through the video. So, first thing we're going to look at is the stock fell about 19% today, and this stock a year ago was all the way up to $280 a share, and now we're all the way down to $100. And the reason the stock fell today is because they lowered their earnings guidance for this year by about 60%. So earnings are going to be 60% less for this year than what they previously thought. And it looks like the main driver of that is because of sales in China, which China sales for this company makes up about 30%, just for reference. And if you don't know, Estee Lauder is the world's second largest cosmetics company. And so that's what we're going to be doing some analysis on today. The first thing is going to be their revenue, and the revenue trend is strong. I don't really see a problem with their revenue. Last year, they did about $15.9 billion of revenue, and it looks like every year they're only growing a couple percent, but it still is, as you can see, the last 20, 30 years have been pretty consistent, and they're growing at, 3 to 4% per year. So that's good. But when we look at net income, this is where things don't look as good because the consistency and the improvement is not there like it is for revenue. So 2014, 2015, they were doing a little bit over $1 billion. This year, they're only doing about $1 billion. So in the last decade, they barely made any improvement. Now, yes, in these 2 years, we see a huge spike, but that was probably driven by the stimulus money and everything else that was going on at that time. In reality, though, these numbers are pretty much flat for the last 10 years. So that's where that's not going to get a check. It looks like it's pretty much stuck at $1 billion. And keep in mind, $1 billion of net income for a $37 billion company, that's a lot. That means you're paying, even with the huge drop we just had, you're paying 37 times earnings now. And I mean, keep in mind, this was, you were paying double and triple that just less than a year ago. So just keep those numbers in mind because this stock does trade at a very rich valuation, and that's what we're looking at right here. Now, if their earnings are going to be, so let's see, if we go to this analysis page, let's see if I doubt they updated it. Yeah, they didn't update it. But this 3.6 now is actually supposed to be about 2.3, okay? It's supposed to be about 2.3, which puts the stock at about 46 times earnings, okay, for this year. But then, as you can see, the next year, the earnings are supposed to jump up pretty big, right? 3.6 to 5.5. Now, I would guess that if this year's earnings are going to be down 60%, it probably means that the next year's earnings are probably not going to be the same number. They're probably going to be down about 60% or somewhere near there. So when we update it for that, then it looks like for next year's numbers, you're paying about 20 to 30 times. Okay. So by that metric, it's not bad because if we want to look at the PE ratio here, we can see that it, like, if you can, so pretty much it looks like if you can get it between a 20, I would say a 25 to a 35 looks like a good deal. And then a 35 to a 45 is definitely on the richer side, even though it does spend time trading at those valuations. But if we zoom out, you can see for a pretty long time, it'll trade at about 20 to 30 in this range, and then it spent some time at 45, 28, 40, and then these are just like outliers. And lately we've seen higher numbers, 30 to 35 to 40. So I would not want to pay 40 times. Even 35 times is kind of pushing it, but 30 times, or I would say under 30 times, I would say that would be a comfortable spot to be buying at. But so off of those numbers, then if you pay 25 times next year's earnings, that's okay. I can kind of see that making sense. But you just have to kind of weigh out your options here and ask yourself, are you willing to take that risk? And, do you think the stock's going to go back to those valuations? Because really, I mean, this stock was almost $400 2 years ago, and we're talking about it's down 70% since then. So it's had a big drop. And even though those earnings are supposed to drop a lot this year, I mean, how we looked at earlier, this is the second largest cosmetics company, and a lot of companies are struggling with stuff like this right now. So I think this is probably one of those players where they're good to go, and in a year or two from now, they're going to be, back on their feet with strong earnings and strong net income. So, I mean, nothing's guaranteed, but it's still, I would say that's the more likely scenario here. And that's why I think I'm kind of interested in buying this. I'm not completely sure yet. I need another day or two to think about it. Um, but I'm definitely interested. It's definitely interesting because this is a type of opportunity where this does not happen very often, and the stock is down a lot. Like the stock's down over 70%, and although the earnings are supposed to be down, it's probably going to return to pretty strong numbers next year. So next up is an innovative. I put Sure because for the makeup industry, cosmetics, yes, I would say yes. They're doing good. In general, are they as innovative as a Tesla or something or Microsoft? Probably not. So it depends what your conditions are. Strong market share, I put yes. This is debatable because they have 14% in perfume. I've seen other numbers about 8%. I would say I think the cosmetics industry for Ulta Beauty, I want to say it was 500 billion or something, 500 billion something, and they're doing what, 16 billion in revenue. So it depends what you mean by market share, because there's a lot of players here. If you're in second place for an industry that big, I would say you have pretty strong market share. Even 14% in perfume, that I would count that. A lot of times I'll say they need to have like 30%, but for an industry like this, I think that they would count as a strong market share company. Return on invested capital, yes, it's usually around 21%, which is strong. Let's take a look at that chart because the most recent year it decreased a little bit. This year, or I don't like when these companies do it like this, where it's their 2023 or their Q2 is different than other companies. So this, let's just say trailing 12 months, ROI is only 8%, but usually it's 21%, 30%, something like that. So I would count that as strong. That'll get a check. Growing equity, yes. Now this is not consistent, not ideal, but I can see where it makes sense because in 2020 to 2021 there was a huge jump, 3.9 billion of equity to 6.9, and then it pretty much has stalled since then, or it's actually come down a little bit, but that's a really big jump in equity. So that's where I'm kind of thinking like, okay, maybe they, they are investing money in other things. So maybe they're investing money in other things, and that's why they're not as worried about keeping that equity going, because that's a big jump in equity there. Then is it over 15% of the market cap? No, because they have $8 billion of goodwill. Now, normally, really, I don't like that. I don't like goodwill being the majority of the assets. But in this case, when you have companies like this where it's brand dominated, it makes sense because that's where your assets are going to be. They're going to be in goodwill because that's how these type of brands carry value to them. So that makes sense. That's okay. But it's still not. They only have $6 billion of equity. So if one of these brands suddenly isn't popular anymore, well, then that's all the value. That's all the equity gone. So that's why I don't really like that. Share count decrease, yes, only by like 1% though. Assets minus goodwill, it is not 2x the liabilities. The margin is over 10%, but barely. If we look up that chart, it's definitely not ideal. But let's see. Yeah, 6%, 13, 17, 5, 12, 8, 10. So they had plenty of years where it's over 10, but you could definitely tell since the pandemic stimulus era, they've been struggling the last 2 years. But I still give that a check. Cash receivables of 5.5 billion. Yes, it's definitely more than their income because the income hasn't changed in a decade. So, I mean, they've had 10 years now to stack up that money. Healthy dividend, I would say no. So let's go to this now. We're going to look at the cash flow statement. They're doing, remember, about $1 billion of net income almost every year, right? Not 2021 and 2022, but 2023. And from 2013 to 2020, they were doing about $1 billion, 1.2, anywhere around there. But they're paying, let's go to how much they're paying out in dividends. Cash dividends paid. So 3 years ago, it was $500 million. Then they jumped all the way up to 750 million. 840. Now we're all the way up to over $900 million paid out in dividends, when the company's doing almost that same amount for bottom line net income for the last 10 years straight. So that's not good. That's a problem. That means they could cut that. They need to cut that dividend in half. Go back to 500 million or something, because, and it's not like their dividend is some super big dividend. It's only 2%. It's only 2%. And that's because they're not getting a strong ROI like what we just looked at. So they're paying out, their net income could be pretty much double if they cut that dividend at like 100%. If they cut the dividend down to zero, they would pretty much double. They'd have $2 billion in net income, right? That would push the stock price up, I would think. Okay, that makes your company worth more. At the same time, a dividend yield can also be intriguing to investors, and that's fine to, pay your shareholders back. But we're talking about half of their possible net income is being paid out as a dividend. And that's because, so their margin was 6% and their ROI was 8%. Okay. That's why they're only, it's pretty much 3% is going to the bottom line, and then 3% is going as a dividend now. So, or, something close to that, because it's a 2% dividend. So I don't like that. I think they need to cut that dividend. If they were paying a 6% dividend or something, then that would make sense, because you're getting a giant dividend and that's where that money's going. But they're not making that much money. They're not getting good return on capital numbers, and their net income could be way higher, and that would increase the value of the company. Is it over 10 years old? Yes. And is the free cash flow improving? No. Normally free cash flow and net income are pretty similar, and in this case, it's pretty much the same thing. Free cash flow, about $1 billion. You could even put in the adjusted one, and it's a little bit different, but it's roughly about $1 billion. So I don't know. I'm interested in this company, but they definitely have some problems. They're definitely doing some things wrong, even if they are the second largest cosmetics company. And what's the market cap now? It says 40. No, it's not 45. It's 37 billion. But the valuation is cheap, because if we knew what they were doing for EPS, that would make things a lot easier, because these numbers are going to change in the next couple of days. These are going to be updated. This year's earnings, which they're saying is 2024, even though it's not that year, is going to be about 2.3. Their guidance was 2.1 to 2.4, something like that. So I think it's 2.3 is going to be about the average, which is about a 60% decrease. Okay. So that means the stock should drop about 60% from what they previously thought they were going to do, which it looks like this year the stock was, hanging out around the $230 mark, $220 mark, you could even say. And so if it's going to drop by 60%, that means it should be a little less than half of that, which means I would probably say the stock should be like probably exactly where it is right now, probably about $100. So that makes perfect sense. But this would only make sense if their earnings, if they were done growing, and if these earnings were not going back up. But if this giant increase here happens, then this stock should shoot up the same amount. The stock should shoot up 30% or 40% within, maybe in a year from now, 12 months from now. The stock should be $140, possibly even $150. Okay, should be $150. Now maybe the sentiment stays bad for this company and the stock keeps falling. A lot of times when stocks have big drops like this, for the days following, the stock keeps going down just a couple percent, just 2% or something. Tomorrow, I wouldn't be surprised if it was down another 2%, 3%. So there's a good chance that happens. That's why I'm kind of curious to see. I don't know if this would be I don't know if this stock is going to be one where it pops off tomorrow morning. I don't know how realistic that is. That's why I'm kind of curious to see, is this going to be $90 a share, in the next couple of days? It could be. And then we've seen some stocks, like look at PayPal, there's plenty of companies out there or look at 3M, look at Dollar General, look at Target. All these companies the last 6 to 12 months have had giant drops and the valuations look way cheaper, but they stay at those levels until some good news comes out, until the guidance gets better, the sentiment for investors gets better. Then you see that stock price jump back up, which that could take a year, because I thought the same thing about a year ago. I invested into 3M maybe 9 months ago, and that stock has only gone down more. I was buying it at $130 a share. I thought that was cheap. Today it's in the 80s. So you can't always tell. You have to wait let some time go by. There's a good chance the stock will keep falling. See how the sentiment goes, and you have to hope that even when the analysts can come out and raise the price targets, that helps. But half the time it doesn't make a difference. Half the time the stock will not move, and it depends on what analyst, what company is the one issuing the price target. But still, the main thing is probably going to be their earnings or the guidance that the company gives, right? That's going to be what drives it. So I'm going to keep an eye on it. I mean, I don't think they're going out of business. If their net income stays at $1 billion for the next 10 years, well, then yeah, the stock might as well stay at this price. But you don't know. You don't know. I would hope they would cut that dividend. They need to cut the dividend. That needs to happen. But other than that, we're gonna see what happens. But the stock price is, if that EPS number is, let's say it's gonna be, I think it's gonna be if they're gonna do 2.3 this year, let's say they do 3.5 or something, right? 3.5 or even 4. Then you're looking at a PE ratio of 25, 30 times, right? For next year, which means for the next couple months, the stock could stay at $100. Which makes me think maybe I shouldn't jump on this right away. I probably should wait at least, a week, a month, something like that, and see what happens. Because if the stock goes to $80 or something, well, then it's interesting. Because then it's undervalued. But right here, for this year, for its current earnings this year, it's fairly valued. It's just, if you want to buy it now, yes, there's a good chance it'll shoot up 30-40% in a year from now, because the earnings are going to shoot up. They should jump back up. I don't think this company is going to stay at this range of $3.30, whatever. And what's the revenue? Well, now these are probably going to change too. But yeah, that's my thoughts. If this stock drops a lot, if this stock drops a lot soon, then I'll start buying shares. But that's the only thing. If it stays $100, I'm gonna watch it for a week or a couple of weeks. Then I might start adding there. But I don't want to buy right now tomorrow morning and then have it fall another 10 or 20%, because that's happened to me several times. So that is my long rant analysis for Estee Lauder stock. Let me know what you guys think. Comment down below.